Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing a friend of mine, Benjamin Demazi, also known as the Royalty King. And so we're going to dive into that. Why are you called the Royalty King here in a little bit? But how you doing today, Ben?
I'm doing very well. Thank you for having me. It's a pleasure to be here.
Yes, so you and I, we've engaged multiple times over the years, and you do a lot of deep dives on your channel on stock valuations and looking at where is the value at, right? And so obviously we've had a big run up in the metals prices recently, commodities and such. And so I want to get your overall take on the macro economy and how you are viewing that in your model for looking at what sectors to be in. And so let's start there.
Okay, no problems. And I'll start by paraphrasing a Peter Lynch quote, which says that if someone spends 13 minutes a year worrying about macro, they've wasted maybe 8 or 9 minutes. But it's kind of a funny way of, it's something that just attracts our attention, and there doesn't seem to be much we can do to pull our eyes away from the news and the forecasting and all the rest of it. In terms of what I'm seeing, basically it is this inevitable and inexorable move towards what now has become the debasement trade. You and I have been talking about the debasement trade for actually some years now, before it was even called the debasement trade. Mm-hmm. And so I think really we're starting to see, I guess, this idea, this notion of a loss of purchasing power in fiat currencies generally proliferating throughout the world. And it's not just the US, and it's not just Australia. It's really all major currencies. We look at fiscal situations around the world as kind of the bellwether. If we have some deficits, obviously that's going to need to be papered over through fiscal policy matching up with monetary policy. And I think we're really getting towards the middle to end game of this debasement trade. So that's what's been on my mind for quite some years. I saw inflation fairly early on the horizon. I'm thinking that next year, possibly 2026 and 2027, we may have some disinflation. I think it's like a little bear trap. And then I think by the end of the decade, we're really going to start to be seeing this constant and persistent inflation creeping through more of the areas of life than we've seen currently. So if we think of inflation as a vector, then we've seen it already in the gold price, obviously over the last 12 months has definitely caught people's attention. So far, we haven't seen it in energy. And if and when we do, I think that will really catch people's attention. Obviously, being such a heavy component in most of the measures of inflation, which we don't have to get into. But that's the way that I'm seeing things. I'm really in the debasement trade as an overarching theme, and how that proliferates across into various other sectors that I like to work in.
Yeah. Thanks for mentioning that. So thinking about that and just unpacking that a little more. So recently, Ray Dalio put out an article about the Fed doing stimulus into a bubble. And the Fed has recently come out and said on December 1st, they're going to stop quantitative tightening. They have not indicated when they're going to start easing again or expanding their balance sheet. But we know that in the recent weeks, there's been some volatility. Some of that has been to like the repo market and some of the liquidity there. And so thinking about, obviously Donald Trump wants to get a Fed chair in there that wants to supports his policies and such. And so, when we get to this point of lower interest rates as well as balance sheet expansion, Ray Dalio argues that assets are going to benefit the most. Like, more steam gets blown into the AI bubbles, the tech stocks, the gold, silver, like pretty much everything. And then inflation. Then when inflation picks up, that's when the Fed has to pump the brakes. And then when they pivot on the loose monetary policy, that's when the bubble pops and inflation becomes an issue. And so is that somewhat of the framework that you're thinking of when you think of like inflation coming back later down the line?
certainly in the medium to longer term. Thank you for bringing that point up. Easing into a situation where we've never had before in terms of the overall debt to GDP is we're kind of in uncharted territory. I think eventually, as you mentioned, apart from the recent activity in the repo market where people are looking for dollars, they're trying to get their hands on liquid dollars for various purposes. Michael Howe's done some great work in terms of, at the moment, we've actually coming towards the end of a contraction cycle in terms of the available liquidity. And I think that's where you've seen recently in the crypto markets, you've seen a steep sell-off since recovered. I think I would subscribe to that overarching thesis of the next, say, 2 to 3 years. I think that coming into May next year, we have a new Fed chair. It's almost certainly going to be a dovish Fed chair, and really, without having to pick who the Fed chair is, if we just look at the situation, I really don't think that there's an appetite for any kind of austerity anymore, certainly that we've seen. I mean, we're here talking about how the quote unquote the real economy, the blue collar economy, the consumer economy in many parts of particularly the US is tapped out. You and I listened to Danielle DiMartino Booth a couple of months ago, giving a great presentation showing the different sectors of the economy that, in her words, the consumer was tapped out. And so we've got to that stage at 4.5% on the Fed funds rate, and all signs seem to point towards a lowering of the rates and an easing of the liquidity spigots. So 2026, I think, will be interesting, and then eventually the price will have to be paid in terms of where the new injection of liquidity enters, and I think then you're going to start to see some of these other sectors that have lagged in terms of expressing this inflationary push, such as in the energy space, really start to catch on.
Yeah, definitely. I totally get that. So just thinking about the movement in gold and silver, and so I have to tell you that I haven't updated you on this bit, but I'm a silver bug now. I am. I've done my due diligence. I've done my due diligence, and silver, like I started buying before, obviously it's close to $60 an ounce, and I've held like my physical silver, but after really diving into the supply and demand issues, as well as the backwardation and everything, like I just got sold on like, okay, yeah, this could easily hit triple digits. And before I used to think people were crazy saying silver could hit triple digits, but now I am a bigger believer in that. But so nonetheless, we have these metals that have been rising significantly, which is the dollar falling against the metal and such. And so what's your overall take on gold and what that means for companies like the mining companies, the royalty and streaming companies, and their profits and their earnings and such? I mean, because it seems like, obviously if there's a higher gold price and their all-in sustaining cost is cheaper than the price of gold per ounce, then they're going to have better earnings and such. And so just curious in what you're seeing there.
Yeah, it's really interesting. We've seen somewhat of a disconnect between the actual commodity price of the metal and most of the producers / developers kind of lagging behind the ball game a little bit. And this has formed part of a theme that I've had for a number of years now, being, first of all, with regards to gold, I think gold is the hurdle rate for most investors. I don't think most investors out there over the longer term, let's call it the next decade, are really going to outperform the gold price. And interestingly, the gold now makes up by far the highest proportion of my investment portfolio. And to be fair, that's obviously due to the large run up in price over the last 1 to 2 years. The way that I visualize this in terms of my investment framework is, if you imagine a line sloping upwards and to the right, I see that as the gold price moving it over the next 1 to 2 decades, 7 to 8% annually, as it has since 1971. If you look at the increase in the money supply, depending on which metric you want to use in the US, not coincidentally, you'll find that the money supply has increased at that same rate on an annualized average. Around this line sloping upwards and to the right, representing the gold price, or the inverse of the dollar's purchasing power, if you will, I imagine like a synovial wave. And depending on 2 to 3 year pockets. I think you're going to have some commodities outperform the gold price, and then you're going to have some commodities undershoot. And overall, I think it's going to be very difficult, other than perhaps for professional investors, to really outperform gold as a hurdle. And so when people are using their discounting rates, I think you've got to use what you think the gold price will do actually as your discount rate. All that is a long way of saying that I'm extremely bullish on gold. And not many people on this channel, I believe, would argue with that. Where we might differ, I suppose, is to what you're alluding, and that is that I believe the royalties provide a superior way of outperforming the metals price or the commodities in general, because as you know, royalties expand to more commodities than simply metals.
Yeah. Okay. Well, let's dive into that. So, what is your base case for royalty companies and royalty/streaming companies outperforming the metal? And obviously, I mean, there's some history there when we look at the charts of, after the prior. Well, some would say we're in a secular bull market, a long-term secular bull market. Some would say, okay, the bull market ended in 2011. Whatever the view is, we can see that the royalty and streaming companies, the Francos, the Wheatons, outperformed, the metal during that time, and the miners. And so, just curious, and why you mention that as the superior, investment option.
Sure, and thank you for bringing that up, because you can't really understand a future phenomenon without understanding that which preceded it. So we have actually, yesterday I put out a research report on what I think is the closest thing to a controlled experiment that you could get in this environment. And this research covers one particular commodity, in this case it's iron ore, and it covers a particular producer that works a mine, and then it covers a pure royalty trust that has a royalty interest on the same mine. Now, since the beginning of production at this mine, the underlying commodity itself, iron ore, has nominally increased at 4% per annum, which is below that of inflation. And this is something I think people really get confused about. People believe that commodities are inflation beneficiaries. And over a long enough period of time, with the exception of 3 commodities, that's actually not true. If we state the US money supply increase at 7.5% per annum, you can see that actually the real pricing has decreased at negative 3.5% per annum for the commodity. So the commodity didn't do very well at all over that time period. If you look at the producer, in this case it was Cleveland Cliffs, operating the Peter Mitchell mine in Minnesota, their performance has been terrible in terms of you actually have destroyed capital. Your return on capital is what you're looking for in an investment, and unfortunately the Cliffs guys have not been able to achieve that. So they actually underperformed, if you can believe it, the commodity that they sold. And this gets to do with the model having a lot of downside leverage as opposed to upside leverage. And finally, we come to the royalty. In this case, the royalty is a company, or not a company, a trust known as the Mesabi Trust. Now, since 2000, the Mesabi Trust, which was trading at roughly 33 million in market cap, has dished out so much cash that if you were to have invested in 2000, you would have made all your money back in less than 5 years and had ex-dividend a 13x return. And so we need to stop here, and we need to talk about this idea of return on capital. This is something that is truly unique in terms of this particular business model. They provide an upfront financial payment for the development of a particular deposit, in this case an iron ore deposit, and once you've earned that capital back, your returns are infinite. It's like this holy grail of investment calculation. And this can continue out for decades and decades and decades, getting paid for a check that you wrote in soft dollars many, 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 many years ago, and having already recouped your entire capital investment many, 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 many years ago. And so this is a wonderful example because it's a single asset. A lot of variables are controlled, and you actually have this situation where, unlike a lot of explorers, developers, and producers, you cannot be diluted because it's prohibited in the trust mandate. So this is just a wonderful example of the superiority of the business model in the asset class over what has been actually a pretty tumultuous commodity cycle. In the worst of the bear market for iron ore, Mesabi Trust was still positive and providing a return on capital to investors, whereas obviously the producer, unfortunately, is unable to make any kind of profit once you are getting to the point where you're below those all-in sustaining costs that you mentioned. And a similar thing has happened with many other examples that I can talk about if you like, including the famous Franco Nevada example. But this, I think, people get confused with the size of Franco being so big. This is a wonderful example because it's almost like a clinical trial that isolates one particular commodity, one particular deposit, one particular producer, and one particular royalty.
We've got 3 of the best porphyry copper targets that I've seen in the past 25 years of exploring for porphyries. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. We've put our foot on 2 outstanding projects in central British Columbia with copper and gold and some molybdenum in there. Our Poplar South project, we're drilling there at the moment, and I think we're on the verge of a major discovery. If you want to learn more, you can find us at vizslacopper.com.
So when looking at a royalty and streaming company, so obviously that what you just mentioned with Mesabi is pretty much a testament to your due diligence that you did on that company. So looking at, mine life, for example, so obviously you have the contracts that are signed, like the capital is given up front, and then, the promise of that royalty is pretty much given back to the royalty and streaming company. And typically that could be over a 10-year mine life or whatnot. And so when we're looking like down the chain, so obviously you have the Francos, the Wheatons, the Royal Golds, which are like the top tier. Then you have the mid tier, the Ora royalties, the triple flags, and so on and so forth. And then you have the smaller companies, which are, the Empress royalties, the gold royalties, et cetera. Metallas, et cetera, right? And so when we think about the deals that are done on mine lives and such, and how are you factoring that in amongst like these 3 different categories? So between the larger companies, the mid, and the smaller companies.
It's an excellent point, and I'll get to that again, answering using the Mesabi example because it's such a beautiful, clean example. At the beginning of 2000, reports in terms of estimated reserves sat at around 500 million tonnes. And the average output for this particular mine is around about 4 million tonnes a year on average. And so you think to yourself, after 25 years, that's roughly 100 million tonnes. The reserves as of today would stand at, let's just say, roughly 400 million, keeping it simple math. And today, actually, if you look at the most recent estimate, the reserves actually increased, if you can believe it, to more like 800 million. And this speaks to a lot of what you're talking about in terms of the life of mine. In this case, you're almost always pleasantly surprised to the upside if you are underwriting correctly in terms of your assessment of the deposits. To answer your question in terms of the landscape for royalties, that has changed quite a lot since, even last year. We've seen Gold Royalty become an acquirer in the space, really going mad in terms of acquisitions to try and get to that position of scale, which they have. We've seen M&A in the triple flags of the world. We've seen M&A recently with Elemental Altus and EMX. The big guys are the big guys, and they, I believe, have a huge advantage actually in terms of their underwriting. When I spoke to Randy Wheaton a couple of months ago, he really changed my mind on this in terms of this idea that Wheaton is so big that it can't grow now, and you're going to have to look down the chain in terms of the smaller caps. He really gave me a different insight in terms of actually Wheaton has more power in terms of being selective in deals that are accretive, whereas a new incumbent to the space, and the space has attracted a lot more competition recently because it's such a great business model. Those guys end up doing some deals that they kind of do just to get their foot in the door, with the hopes eventually of getting to the point where they can be more selective with their deals once they've hit scale. And we've seen this in a few companies that have had these buyback clauses. So they've got their first deal, they've gone and started to receive royalties, and then in 3 years' time, the mine has got into production, all is looking good, and just when you're about to hit your straps from a royalty owner's perspective, the producer exercises their buyback clause. And so I really think that a lot of the best life of mine deals are actually found at the top end of the stack with the guys that have their in-house geology teams like Wheaton. Those guys seem to have advantage in terms of life of mine. And finally, to address your point around the life of mine, it really is a deal-by-deal scenario. So you need to do your due diligence and look at how long the agreement lasts for and what you think the estimated reserves are going to be. With the example I gave with Mesabi being that it's very, very common for you to be surprised to the upside in terms of an increase in reserves. And the beauty, of course, as a royalty or streamer is you don't have to pay a cent for the capex to expand into that production, yet you have a call optionality on that increase in price and volume into the future. So it's a wonderful, wonderful place to be.
Okay, got it. So thinking about the deals that are being done, so obviously the top tier companies are going to get the best deals. I mean, and typically they have a lower if they need to access financing or any of their debt instruments, credit or whatnot, lines of credit, they typically get lower interest rates and such. And so they have a lot of advantages there. I'm kind of wondering about them being selective, but then also what about the potential for growth? So some of these companies obviously buy projects that haven't been developed, or they're in the exploration phase and such, and then there could be some future, metals that come out of the ground there. And when you're looking at the assets of these companies, so obviously you have the ones that are currently in production, and you may have some that are in development, some that are in exploration phase. How are you factoring that in when you're looking at these companies? Are you looking at mostly factoring in what's produced and coming out of the ground today? Is that how you factoring your models to project like the cash flows and things of that nature?
Not so much. I tend to find the best advantage, if we think of the equity yield curve, which I've written about, actually comes looking maybe 3 to 5 years out. So I love the question because I heard the comments last year that Franco and Wheaton are somehow ex-growth. Wheaton Precious Metals is set to almost double their production by the end of the decade, and they'll be the first company in history, should they reach this milestone, which I believe they will, of having a 1 million gold equivalent ounce production per year. And so that is 40 to 50% growth on where they'll be as of 2 years' time, which I think is quite phenomenal. That's something we'd associate with a small cap. So to have the biggest and best in class exhibiting such a growth in production volume, pick a number in terms of what you think the gold price will be in 4 to 5 years' time. And I think you can look back and see that currently Wheaton actually offers quite a substantial growth runway. 2 years ago, sticking with the Wheaton theme, I looked at Wheaton's estimate for production over the next 18 months. And I said to myself, yes, I think that I believe their numbers. I believe that they can hit this amount of production. And whilst gold was bouncing around the $2,000 mark, slightly below, I made a call in terms, I thought that gold would hit $3,000 an ounce comfortably. And so I wrote a long form research to my audience, and I laid this out, and I said, at this production amount of gold equivalent ounces at a gold equivalent price of, let's call it $3,000 an ounce, you can underwrite it at the price you wish. I think that Wheaton is a $40 billion company, and today it's trading at roughly 20. So the ability to earn 100% return over 12 to 18 months, it turned out being less than a year, was obviously too good to pass up. Speaking of Franco-Nevada, and this is a great example to your point, people are looking at Franco's production numbers as they are today, and yet they're not realizing that over 75% of their contracts actually aren't even in production yet. Several years ago, Franco made the decision, they made a call, I suppose, a macro call on the gold price, and they started to acquire contracts on projects that would not be viable at less than, say, $4,000 or $5,000 per ounce of gold. And so these are really like high leveraged call options into the future, which don't carry any negative theta. In other words, without speaking options lingo, you have this free optionality on a much higher gold price. And so you need to ask yourself today, with gold ticking over $4,000 an ounce, those deposits are starting to come into the money. And so Franco, quite intelligently in my mind, has almost 3/4 of its book exposed to undeveloped projects at a much higher gold price, which is obviously a huge runway for potential growth just in production alone. And then obviously you have the twin engines of price to go alongside the volume. And as a royalty owner, that's what that's the function of your earnings. Is revenue is production times production volume times price.
Yeah. Thanks. So these companies, or this model is, I kind of refer to it as like, it's almost like a bank. It's almost like an investment bank for the mining sector. In terms of, they provide the capital to get the projects off the ground and so on and so forth. And there's just tons of projects everywhere. And then you got jurisdictional risk and all of that. So the top tier companies can be a lot more selective in what projects they decide to fund. So I'm curious in your perspective on so thinking about, some of the contracts are not in production yet. So obviously you could bet on future growth with Franco Nevada or Wheaton or whatnot. How do you think the smaller caps fit into this? Like, obviously, when you have a smaller company and you have smaller mines that need to get capital to get their projects going and such, they're probably not going to be as picky. But then you have like this dynamic of where, as the gold price increases, more bigger banks may be willing to provide that capital themselves. And so I'm wondering about the terms of the agreements and how that may shift, in the future. And so just curious if you have any thoughts there.
Sure. My thoughts are, I think royalty and streams will actually become more and more attractive and more competitive in terms of their space. There are really only three ways to fund the development of these types of deposits when we're talking natural resource. One is bank debt, which you mentioned. Then you're beholden to the bank in terms of their terms. Depending on the commodity that you're trying to underwrite, many banks won't lend because of ESG concerns and whatever else we're doing in terms of the politics around lending. And obviously you have the investor's worst fear, which is dilution, which is a permanent impairment of capital. So royalty and streams are actually some of the most attractive forms of financing to get your project into production. In terms of competition in the space, I think you'll start to see that the smaller guys are doing these deals that I mentioned. More due diligence will need to be deployed around the smaller royalty and streaming companies. Uncle Rick calls these the Johnny-come-lately companies. They're trying to get their foot in the door. They're trying to hit a certain scale. And so they're going to be operating at that end of the market where smaller deposits, life of mine, will need to really come under scrutiny in terms of an investor underwriting. Another advantage, again, this tends to accrue more towards the larger cap companies in the space, is the ability to finance byproducts or offtake agreements. So if you've got a big copper mine which is coming into production, copper gold porphyries often have gold as a byproduct, and these guys are not particularly interested in the gold, but they want to monetize it. This is the perfect scenario for a streamer to come in to provide steady injections of cash over time. I'm not sure if you want to talk about the difference between streaming and royalties, but in any case, getting royalty or streams on byproducts, I think you'll start to see more and more coming into the next decade, given that we have particularly a copper shortage.
Mm-hmm. Yeah. I've been looking at some of the copper royalty and streaming companies, and obviously you mentioned like some of these deals may come on the byproduct metals. So if a mine is focused on gold, and obviously silver is a byproduct of gold mining, that could be opened up for a royalty on that particular project and such. And so I could see that definitely leading to some opportunities. I'm curious in if you have any thoughts on the recent news that came out about Tether buying into gold companies, and they're specifically buying into royalty companies. So you have Altus, Elemental Altus, Metallo Royalty, and Gold Royalty. And so I was kind of just curious. I mean, I haven't looked into the mechanics of it. Like maybe they're getting access to the streams to so that they can get the gold to back their tokenized gold to, or whatever. I don't know. But it was just, I was curious and just like, oh, that's interesting. They're only putting capital into the royalty and streaming companies.
Yeah, it certainly is interesting, without a doubt. I've been a beneficiary of them doing so, so I hope they keep doing it and bidding up my shares. But I think it tells us a lot about the long-term strategic planning of Tether. They want access, as you mentioned, to gold, potentially silver in the future. What their plans are to do with that, obviously, I don't know. I'm not privy to their corporate policy. But certainly some form of tokenization of the gold and silver market is well and truly underway. It's not news. It's been, various people have been trying to do this for a while. Or potentially Tether just sees the ability to earn a great return. The amount that they've injected into these companies has made a huge difference in their share price, but it's actually a de minimis amount of cash if you look at Tether's overall cash position. So to them, I think they get some asymmetric upside if they take a view on the gold price or the silver price, but I don't think it's going to form a huge part of their current business plans, at least for now.
Mm-hmm. Gotcha. Okay, cool. Thank you. And so obviously gold price has been running and a lot of other metals are at all-time highs measured in dollars. Oil and gas. So I know you're big into oil and gas, and then you also specialize into some of the oil and gas royalties as well. I mean, you do some offshore and stuff too, but just sticking with the royalty and the royalty company model. What are you seeing as far as like opportunities in oil and gas with royalties?
With the royalties, again, I understand what you say when in terms of you're big into oil and gas. I think it's probably best to say I'm into land with royalty rights attached to that land. And obviously, the mineral estate under that land holds an awful lot of oil and gas, depending on where you purchase the land. And so having a royalty on that is how I like to position myself. Daryl, do you remember in 2020, I think it was April 2020, when oil prices, or oil's future contract actually went negative for a short amount of time? Because if you do, obviously this was terrible if you own the commodity. Obviously this was terrible if you were an Exxon or a producer somewhere in the Permian or elsewhere. And yet, even with oil prices bouncing around at such anemic levels, the royalties and streamers of the world were actually able to finish the quarter with positive profits. So they were profitable in what would have to be the worst possible environment that we've ever seen for the commodity. And I think that speaks volumes in terms of, when I saw this sort of thing, I just said to myself, well, really, this is where I want to be. Particularly energy has broken a lot of hearts over the last few years. I think it will have its day. This is an example. Remember, if we come back to that linearly upward sloping line being the gold price, energy at the moment is obviously about to hit a nadir. And I think it will have its time when it overshoots. And then I think it will come back down again. A great example of how most commodities over time, their trend is towards deflation in real terms. You'll have a lower real price for most commodities over time because producers are incentivized to produce. We've seen the natural gas price do very well for a number of different reasons. Another advantage of owning land, in particularly the Permian Basin, which is obviously the most prolific oil producing zone of the US, is that you have access to all parts of the well cycle. So you have oil and gas royalties, that's easy to understand. You have access to lease and easement payments. So if you're Texas Pacific and Chevron or Exxon or whoever it may be wants to drill for oil on your land, they pay you a lease. They pay you an easement fee. They buy a lot of sourced water to use in their fracking from you. They give you a clip of the royalty when the oil comes to the surface and they take it away. They give you a percentage of that. And then you have this problem of produced water, which for the life of me, I can't understand why more people are not talking about the problem of produced water, particularly in the Permian Basin. For every barrel of oil that comes to the surface, you have, on average, 4 barrels of produced water. This is highly toxic stuff. It must be dealt with in a specific way, and it's a real problem. So these producers pay to have these barrels taken away, mainly via pipeline now. And so being able to take a clip of every stage of the well cycle means that even in a weak or bear market for oil and gas, let's say, you're continuing to monetize and getting paid on price plus volume. You're not exposed to any type of capex or opex. So it's just yet another example of how a royalty or streaming model is a superior business model if allowed enough time to express itself.
Okay. What's very interesting is how these companies performed when oil was negative a barrel back in 2020. So what are those like? Obviously, the deals that they cut and the contracts they have with folks having to use their land and such, and regardless of whatever royalty business model, what do you think are like those main factors that shield them from like the volatility of the underlying asset?
Sure. Best way to do it for listeners that might be this way inclined is to take a 10Q report of a royalty company and then overlay it with a 10Q financial statement of the operator that operates on their land. And you'll see that the operator's expense column is like twice the size of the financial statement or the income statement of the royalty. So what does that mean? It really means, again, as a royalty, you're taking a collection, you're taking a percentage of the revenue or a percentage of the production off the top line, and you're simply not exposed to all these expenses that a developer or operator is exposed to. And over time, this means that most of your earnings actually accrue to the shareholders. And this is a really, really key and yet misunderstood point. Take an operator that has putative earnings of, let's call it $8 per share, and it's trading at a PE of 8. $64 would be the expected price, of course. But you've got to dig into these $8 worth of earnings for an operator because most of those earnings are not available to the shareholders. You can't really take most of those earnings out and go and spend them on whatever you'd like as a shareholder. Most shareholders won't even see those earnings. Over time, maybe 25% over a full cycle of those earnings will accrue to the shareholders versus the royalty co. It's already made its upfront capital investment. Those earnings really are available to the shareholder. And so over time, you have a much higher degree of compounding because you don't simply have the expenses to operate the business and you don't have to keep tipping in more cash in terms of sustaining the business or growing the business. And of the earnings which you earn, 90% of those really are, in most cases, available to the shareholders. Or again, to quote the great man, your gross is your net in these types of companies. And over time, that is what allows these companies to compound at incredible rates of return on equity.
Mm-hmm. Okay. Yeah, thanks for sharing that and breaking that down. So do you have a rule of thumb as far as like looking at G&A costs and when it comes to the royalty companies, like should it be a certain percentage or so how do you view that?
I don't have a hard and fast rule. And to use many of the Mesabi-like examples, because there are many express trusts that are set up in a similar way, you'll often find SG&A will struggle to be even 3%. Because what is this? It's an entity, a collection of legal documents. Their only expenses for the year are their filing costs, making sure they report on time. There's no management, there are no employees, and auditing costs to make sure that the operator isn't lying about their production numbers, basically. And so this is where you really see, again, another aspect of the superiority of the business model. It just doesn't take a lot to keep these things running. And so SG&A should, in theory, be somewhere around less than 5% of total revenues for this company, because there just aren't that many expenses. And when you compare that to various other, shall we say, lifestyle companies in the space, in the commodity space, it really makes you wonder who is working for whom in terms of management and shareholders.
Yeah, definitely. That's good. That's good to hear. Good to know. Well, shoot, Ben, appreciate you coming on the show and just breaking it down for the audience, especially just looking at this business model. It's cool because it is connected to the price of the commodities that many of the viewers of this channel are invested in, and so it's important to like understand the different optionality there and what are the best options in regards to risk return and risk reward and such. And so appreciate you breaking that down. So where can people connect with you, find more about some of the research you're doing? I know you dive into specific companies and such, and you have a Substack and a YouTube channel, and so plug the audience with where they can connect with you.
Sure, that's easy. You can find me over at Substack at The Royalty King. I publish a research report called The Royalty King's Report. Really is the royalty model is the purest expression of economic truth in commodities without exposure to the downside, ownership of volume and price. And so I'm not here to convince anyone. I just publish research on that which I know well, and that where I have my money where my mouth is, so to speak. And if you believe the world needs more materials, energy, iron, copper, gold, royalties, in my opinion, are the most rational way to own that future. And I share my research with readers in terms of how I am doing just that. So at The Royalty King, Twitter, YouTube, Substack. Thank you very much for having me. I really appreciate it. Hopefully this was valuable to the VRIC audience.
Yeah, for sure. Definitely value to me, hopefully to the audience as well. So you all be sure to check out Benjamin on those particular sites, Substack, as well as X and YouTube. And be sure to hit the subscribe button and click the link that is pinned in the comments. That is to the Vancouver Resource Investment Conference. Love to see you there in person. And until next time, Ben, appreciate you for coming on the show.
Thank you very much.